Many of these investments are pitched, and pitched by other advisors even, is they try to make you feel special and that you have special needs. You're Mr. Moneybags, so you must be privileged. There's not everybody who can use these, so you're the sophisticated investor. You should be introduced to ideas that you're not familiar with, that are complex, restrictive, expensive, and risky, because that's the only way to do better. Huh? This is Neil Gendreau, your money doctor, with another podcast. Today's podcast, the topic of discussion is alternative investments and private placements. So, what are these? Well, an alternative investment, by definition, is a certain investment strategy that typically is not publicly traded. That's why it's private, which means that it's less liquid. It's less accessible to the general public. So this isn't for your average normie trying to save some money. Certainly, there's a lot involved with many of these strategies that deserve a lot of complex knowledge and attention. And because of that complexity, the management is typically a lot more difficult to pull through, and you need to work with an active professional to be able to better understand these instruments, what they do, and how they may apply to your portfolio as might be appropriate. But they're certainly not for everyone. Just to give you some examples of different types of alternative investments, the most common type, the most obvious type, and the type that most people are actually eligible to participate in within the general public would include real estate investment trusts, otherwise known as a REIT. And a REIT is just professionally managed real estate on your behalf. But here again, it's done privately through an independent company. And the focus of the real estate management may include either residential properties, commercial properties, storage facilities, or medical facilities. Another type of alternative investment that's become increasingly popular over the last several years is private equity, which, unlike public equity, it's not publicly traded in the markets. These are companies that have not gone public yet. But nonetheless, they're still at their relative infancy stages of development. And so they require a lot of investment capital to get started and to fund their operations. So alternatively, that might be done through private means. And one mode or methodology is private equity, where there's a partnership formed of investors who are willing to allocate their investment dollars to any combination of these non-publicly traded companies that need funding, and it's managed accordingly by professionals who are running the fund. There's also private credit, which is similar to private equity, except it's lending. So likewise, there are private funds that lend money to these non-publicly traded companies outside of publicly traded bonds, which they're not eligible for, and banks. These companies might access bank lending, but bank lending standards become increasingly stringent, and so as a second recourse, they rely on private credit. The consequence of that is if the private credit fund managers are willing to extend credit because of the increased risk involved with the capitalization, there's typically a higher interest rate charge in these loans. But there's also a greater chance of default or insolvency as well. These are the pros and cons. We'll get more into this later. It's a long list of different things that can be done, and so you can actually make a video on each one of these items, but what we're trying to do here is to give you a general overview of how these programs work, what their purpose is for, why people invest in them in the first place, who's eligible, and most importantly, what are the risks involved, because they certainly don't come without risk. If you thought the stock market was risky, this is another dimension altogether. Furthermore, another type of alternative investment might include oil, drilling, and natural gas pipelines. So once again, not all oil companies are public. Some are private. They're looking for funding. They're looking for capital. This is another way that it might be provided. Also, infrastructure. And infrastructure would include projects that facilitate the construction or building of bridges, utilities, transportation. So the whole point behind the infrastructure fund is to provide funding that's not accessible through public markets. And the source of return or repayment of the money that's issued, the different sources of return might include tolls, like, for instance, on bridges, or usage fees on utilities and transportation. By far, the most common type of alternative investment that have been around for many years, at least 2 or 3 decades, are called hedge funds. And you might have heard of these before because, like I said, they're very common and there's a lot of chatter in the news about them. What hedge funds do is they focus more on any combination of esoteric investment strategies that are not typical towards traditional investments. And they may not necessarily be investing in non-public companies per se, but they might be investing in more obscure or more arcane areas of the financial markets that are less familiar to the common individual, or even accredited advisors who don't have a lot of experience trading these. But it varies, and there are some strategies that are more common and more typical than others. But as the financial markets evolve, so do the list of hedge funds and what they invest in and how they do it. So these might include long short funds. These were probably the original types of hedge funds that were issued many moons ago. Basically, a long short means that the fund managers might capitalize on trying to make profits against investments, both by buying them and hoping that the price appreciates, or going short that the investment might fall in value. And so this is done in recognition that markets aren't always positive, and they're trying to capture positive performance from both sides of the market. Most times, like if you have a brokerage account, the typical investor will just buy stocks long. That's very common and easy to do, but they go short, whether it be with short sales or put options, etc. That takes another dimension altogether for most, and here again, more people are more comfortable relying upon professional management to do that. In addition to the basic long short category, newly speaking, there's something called the tax-sensitive long short version, which gets a little bit more complex, particularly with the pass-through of gains and losses. With trader funds, unlike most hedge funds, the losses and gains pass through as ordinary income and losses rather than capital gains and losses. And that's important because for those people who might have not only a large amount of financial assets, but also a large amount of income through a variety of sources, if certain trader funds generate losses, they call these tax-efficient funds because they're actually trying to generate losses by doing a lot of trading on margin. I have my own skepticism about that, but the idea behind it is that the losses generated can pass through as ordinary income to create offsets against ordinary income and reduce income taxes for those in very high tax brackets. We'll get more into this later. As I mentioned before, a lot of times hedge funds will invest in financial derivatives, specifically stock options and futures of various items. Futures are contracts, as well as options are contracts to buy or sell an underlying instrument at a certain price before or at the expiration date. And so options are traded typically against stocks, while futures are more commonly traded against commodities. There are also interest rate futures that bet on the direction of interest rates, which include swaps and derivatives. Then there's something called relative value, which means the hedge fund is looking for price discrepancies within similar securities. So what that means is that you might have 2 stocks in the same industry with very similar profiles. One might be considered overpriced, and one might be considered underpriced by the managers. And the managers will think, well, it's not really efficient. How can we profit from this market inefficiency? And what they'll do is they'll go short on the overpriced stock and go long on the underpriced stock in hopes that eventually they will reach an equilibrium, which will give them gains in both directions. Here again, there are a lot of hedge funds that are completely valuation oriented. They call those quants. So quants typically is just done by complex computerized algorithms. The programs or the designers try to assign a fair market value for a certain security based upon its underlying fundamentals. And if they find a basket of securities that are underpriced, they'll buy those. If they find a basket of securities that seem overpriced, they'll short those. Then there are event-driven hedge funds, which include mergers and acquisitions. Typically, if you're a company that's likely to be acquired by somebody else in the near future, if there are rumors or speculations around that, then your company that's being taken over can increase significantly in price because most takeover offers are done at a premium to the actual value of the company. So certain fund managers might focus on those stocks that have a very high chance or probability of being acquired by someone else at a premium. Then you have global macro, and what that simply is they focus basically top down, which means they focus on global economies in terms of their areas of investment emphasis rather than individual securities, which become a secondary consideration in terms of their selection process. And then you have funds of funds, which is interesting because there are some hedge funds that are actually a wrap-up of several hedge funds in these former categories that I just mentioned, all in one instrument. So they call that a funds of funds approach. You have one hedge fund that includes 7 or 8 hedge funds inside of it that arbitrage between these different types of strategies. That being said, how are these different alternative investments, how are they created, and what's their basis of formation or organization? This is very important for the purposes of reporting income, taxation, and also whether or not certain alternative investments can declare certain losses at different types of income. It gets complicated, but most alternative investments are held as partnerships. What a partnership simply is a collaboration of owners who decide to get together and pool capital for the purpose of making investments. Typically, you'll have a minority of general partners who are responsible for the creation and management of the fund. They might contribute a substantial portion of their own capital to start funding process. And because they're actively managing the fund and the certain investments within the fund, they actually are fully responsible not only for the investments themselves, but if there are losses against their portfolio that exceed the portfolio value, like for instance, if the fund goes underwater because of bankruptcies, excessive leverage, or other types of business failures, any excess losses can be applied against their personal assets in terms of recapturing the amounts owed. So they have the most responsibility, but they also have the first access in knowing how to profit from managing these investments. And of course, they're the ones that are profiting from the fees that all the other partners pay. All the other partners that participate within the fund are usually considered limited partners. In other words, their maximum loss is limited only to the investment that they make. These are people in the public, or they could be pension funds that make investments, but the extent of their responsibility is only the value of that investment. In the event of an insolvency, courts can't come after any of their other personal assets. So their losses are limited to the investment in a partnership. So this being an introduction of the different types of hedge funds and how they're created, how they're financed, why at all do people use these? Well, the biggest purpose is because of diversification. Keep in mind that all these investments, at one extent or another, go against the grain of traditional financial markets, typically stocks and bonds. And so because they go against the grain, they may have different performance characteristics that offset the risk of more traditional investments that people are more fully invested in. So what they call that is negative correlation, which simply means that the risk profile of these investments, they tend to move in opposition to public markets rather than in conjunction with them. So obviously, if you have two pools of investments, one traditional, one alternative, if the traditional goes down, it's more likely expected that the alternative goes up. And correspondingly, the opposite is also true. If traditional investments go up, more likely alternative investments might go down. So what the overall goal is, by including a broader category of investments via these alternatives in private placements, is what's referred to as alpha generation. Alpha is simply a measure of risk-adjusted return. So in other words, by including some of these instruments within a portfolio, theoretically, you might be able to expect a better return after the risk that's involved within the entire portfolio. The risk being different with alternative investments might actually help to serve against the broader markets and give you a better risk-adjusted overall profile. That's the idea behind, or the main idea behind using alternatives. The alternatives also might have, depending upon their characteristics and nature, certain tax benefits that may not necessarily be available to other investors. And so these losses, as well as the gains, they have to be reported to participants or shareholders somehow at the end of each year. Like, for instance, if you have an IRA or a brokerage account and it generates taxable income, you get a 1099 from the broker that you're reporting in your tax return. Well, likewise, each of these different entities also have their own tax reporting. Since most of these entities that I mentioned are classified as partnerships, what the tax reporting goes through is on a form called a K1 distribution. That's simply the form that's used to report gains and losses. On certain partnerships, some tax losses may be reportable against specific types of income. It depends upon the nature of the loss. So the most common losses that might be generated are capital losses for losses on investments that are sold at a lesser value than what they're bought for. Those losses can only be reported against capital gains from other areas of your portfolio. It can't be offset against regular income, which might include wages, salary, business income, or even passive income. Most partnerships are considered passive investments. If you're a limited partner in a partnership, you're not actually managing the underlying investments. You have nothing to do with it. You're not an active participant in either the management of that fund or in the innate economic activity in which those investments are being made. So as a limited partner, you can only offset passive losses against passive income. That's the general rule of thumb. So passive income and loss is attributed to investments where you have no active management. This includes real estate, even real estate that you might actively own and manage yourself, which is strange. It's a strange exception The IRS is always strange, and they have rules that don't make sense for most people. But nonetheless, that's the way it is, and you just need to be aware of these different parameters because it helps you to make a more intelligent choice as to whether to select any investment. Now, here's an exception that I'm talking about, is that you can deduct certain losses that are typically passive against ordinary income. That might include in the area of oil and gas partnerships, initial depreciation and/or depletion costs that are incurred while the partnership is developing, while the infrastructure is being built, and before any drilling at all or transport of the natural gas and oil is actually generating revenue. So the initial years, oil and gas partnerships typically generate substantial losses, mostly due to depreciation and depletion that create net losses on that portfolio. Normally, those net losses can only be used against passive income. But if you're a general partner, as opposed to a limited partner, you can offset those losses against all other income, which once again would include wages, business income, investment, IRA, distributions, etc. Or you might be able to do a Roth IRA conversion with the additional loss. So it gets tricky, but this is what I'm saying. These investments can become extremely complicated with how they work, their tax rules and regulations, and whether or not they might be used appropriately for one investor versus the other. So either you or someone you work with needs to be very proficient at understanding these differences. Another strange exception is for long-short funds that they call trader funds. Trader funds are a special classification where, once again, the investor, who normally can only take capital gains and losses on the portfolio, can now take ordinary losses on the portfolio based upon this specific classification of a trader fund, which means that it's primarily designed for active trading. It allows all participants to take ordinary losses against short-term trades, which is really crazy because it's really no different than the other hedge fund or partnership. So these are some of the crazy things you have to understand and deal with in order to better understand whether or not any of these investments are appropriate. Likewise, gains and dividends are also reported, mostly as ordinary income paid out from private credit or infrastructure or eventually oil and natural gas. The more common type of gains that are paid out would include capital gains and also depreciation recapture, mostly on real estate and infrastructure investments. Here's another crazy thing. If you include oil and gas drilling partnerships in your IRA, of course, most IRA income is tax deferred until it's withdrawn. That's the standard procedure, right? So you think any investment you put in here, including that of an oil partnership that may eventually generate income, will remain tax deferred until the proceeds are withdrawn. No. There's something called unrelated business taxable income that within IRAs might be recognized if the operating entity or investment within the IRA is not consistent with the purpose of the IRA itself. And so since the oil partnership is doing its own thing in generating income and losses, whatever income it generates, because it's not the same as IRA income, becomes taxable income and recognized when it's paid, even if it remains within the IRA. How crazy is that? It makes no sense whatsoever. Neither does the IRS, but once again, that's the whole trick of the matter, is dancing around these loopholes, finding loopholes for yourself or for your client that might make these investments somewhat worthwhile for certain prospects or for you. Now, REIT income, a real estate investment trust, here's the exception with REITs. REITs are not partnerships. REITs are a special entity, a special pass-through entity that qualify as such as long as 90% of the real estate income is distributed as a dividend. Then the REIT will qualify as a pass-through and not a corporation. So it's taxed differently because it has its own special tax rules once again, not only for depreciation, which is always classified as passive income, but REIT dividends that are paid from the underlying rents that are collected on the properties, less the expenses that are incurred, those REIT dividends, a good portion of those dividends, after depreciation deductions, are subject to what's called Section 199 treatment. And what that means is that the Section 199 dividend income may qualify for the qualified business income deduction, which may be as much as 20% of the Section 199 dividend. So it's very valuable. And the premise behind that is that it's included in a pile of different business entities, including other pass-throughs, such as S corporations, sole proprietorships, partnerships. All of these different entities are specific to a certain trade or business. All these trades and businesses are allowed the treatment of a Section 199. So with REITs, it also applies, but only to REITs and not to other partnerships from an alternative investment. This is the exception. Also, whatever is passed through as depreciation, well, depreciation isn't a cash expense. So it's still cash flow that's generated by the REIT, but the depreciation portion of the dividend paid is paid as a non-taxable return of capital. Why is it non-taxable? It's non-taxable because depreciation is deductible from all the other income. And so because it's deductible, it's not taxed. So that portion of the cash flow paid as a dividend doesn't qualify for the Section 199 qualified business income deduction, but it isn't presently taxed to you. What depreciation does to real estate in general is that it reduces the cost basis of the real estate that's bought. So let's say there's a real estate unit within the REIT that was bought at, let's say, $5 million. Let's say that over the course of time, while it's owed, it may have $4 million of depreciation deductions. Well, the cost basis when you bought it is what you paid for it, $5 million. But the cost basis when you sell it, you have to deduct the depreciation because they gave you an immediate tax benefit on that during those prior years. So now your cost basis is $1 million. And so when that property is sold, let's say it's sold for $10 million, you bought it at $5 million, you have a $5 million gain, but of that $5 million gain, the portion attributable to the cumulative depreciation, or the depreciation that reduced the cost basis, is subject to what's called Section 1250 recapture, which means that that depreciation part of the reduced cost basis, it's taxed at ordinary income, but no higher than 25%. So the highest ordinary tax rate for the federal government is 37%. But if your marginal tax rate is higher than 25%, you'll be limited to paying a tax on 25% of that recaptured gain. And then the remaining $1 million of gain, which is 5 minus the 4, that came in as depreciation, the remaining $1 million of gain, that's assessed at capital gains rates, which are even lower than 25%. The maximum capital gains rate is only 23.45%. So you see how crazy this is and how complex? And I'm just talking about the different sources of income and how they're taxed. So you can see why one investor might use one type versus another, depending upon what his tax preferences might be, let alone trying to diversify outside of traditional investments or public investments. But here again, with all these specialized treatments and possible advantages that might accrue with a private placement, you have to be aware of also the limiting aspects of private placements. A private placement, because it's subject to limited capital that's restricted to funding specialized projects in most cases, or if it's being tied up with an active trading strategy, most often the case, there's going to be limited liquidity of any of these investments. In other words, you can't just buy and sell it at will. You can't buy it 1 year and sell it 9 months later, or maybe even 5 years later. There's an expected holding period that's disclosed within the offering memorandum. And within that holding period, which is the expected amount of time where they anticipate a liquidity event, if any at all, they might not even have a liquidity event. In the case of many hedge funds, there's possibly no liquidity event. They just keep on going in perpetuity. Those withdrawals that you might be able to have are limited. You might only be able to draw under certain intervals and certain events that might allow you to take money out of your private placement. So you just can't take out, let's say, if you invest $1 million in a private placement, you can't decide the following year to withdraw $500,000. That's not going to happen. Your withdrawals might be limited based upon some periodic schedule, typically monthly or annually. You might be able to take out a small fraction of the portfolio investment that you made. But there are also exceptions for death and divorce. Obviously, if you're the owner and you die and your beneficiaries inherit the asset, this may not be a good investment for them. So in that case, the REIT might, or the alternative investment might honor a full liquidation at the death of someone, or likewise a divorce. If you and your spouse are at odds with each other, then if you divorce and the other spouse gets half, let's say, of your assets, well, the half that your spouse gets, maybe he or she might not really be prepared or qualified to deal with that investment. And so with the quadro distribution rules, they'll make an exception for that as well, typically. At the very least, allowing a split of assets so that the corresponding spouse can get their share. And if that spouse is qualified to continue to hold the investment, he or she might be able to do whatever they want with it, but they might have greater accessibility to a full withdrawal, like I said, if they don't qualify. And of course, any of these alternative investments that provide periodic income, such as real estate from rents or private credit from interest on the lending that they do, or the infrastructure profits that come in through fees and usage and tolls and what have you, or the oil and gas partnerships that eventually start generating revenue once they start shipping and delivering their oil or natural gas, whatever the commodity is. Those income distributions that are paid as dividends, you might also be able to withdraw. But generally speaking, you're not going to be able to withdraw a lot on a regular basis from any of these investments. So that's why it's important to make sure that you don't bet the ranch on any of these things, let alone that you have enough money set aside that is easily available to you in the event that you need to supplement your income if you're retired or you have an emergency or what have you. Because of this limited liquidity that the partnerships and the REITs require, to hold and manage the investments and to make them effective for all the participants. These investments typically can't be purchased by your typical normie. So if you got a person that has $100,000 in savings, they're not going to qualify for this because they don't have enough money to qualify. They can't possibly expect to lock up their $100,000 for an unlimited amount of time or an indefinite amount of time and expect never to use it. So there are qualifications that are put in force that make sure that the people who participate are financially qualified to do so. In other words, they can afford to give up some liquidity to be able to gain some of the more privileged advantages of using some of these more obscure investments. But the qualifications that are required are also done so that the issuer or the offerer doesn't have to register or report with the SEC. So in absence of those registration and reporting requirements, there's often less information available on any of these investments unless you specifically ask for them from the managers themselves, but it may not necessarily be publicly required. There are no prospectuses with any of these different private placements or alternatives. What you'll get instead is what's called an offering memorandum, which I don't know what's worse between that and a prospectus, but likewise, the offering memorandum will have like a phone book worth of disclosure and data on the proposed investment with how it works, what the fees are, what the tax benefits might be, the type of reporting, the entity structure, etc. But you need to fully understand that, or understand that to the best of your ability before deciding to make these investments. So you can't just be the average dummy on the street with just a little bit of savings. You have to have some pretty substantial net worth. And there are different categories depending upon the nature of the investment itself, the complexity of the investment, and also the extent by which the money might be held illiquid. There's what's called the classification of accredited investor, which is the minimum requirement for most of these alternatives, where any purchaser must have at least $1 million of liquid net worth, or alternatively, $200,000 of annual income reported on their tax return, $300,000 if married filing jointly. That's like the minimum standard for most of these alternatives. But because some of these alternatives require much higher minimum investments, some alternatives, especially private equity, might require as much as $500,000 as a minimum investment. And with investments like that are for a proposed very large amount that might be locked up for a while, those investors typically must be what's classified as a qualified purchaser. A qualified purchaser must have a minimum liquid net worth of $5 million, as to only $1 million for the accredited investor. The only exception to being an accredited investor, a qualified purchaser, is that for most REITs, many REITs have more lenient qualifications. Their holding periods are typically shorter, which may range for only a few up to several years. And because of that, REITs might only have a limitation for the percentage of investment assets that you may put into any of these real estate investment trusts. So in other words, you might not be an accredited investor or a qualified purchaser, but for most REITs, they limit your investment to a certain percentage of your liquid assets. So if your liquid assets are, let's say, $250,000, they may limit your investment to typically 15%, which means that the most you could put into any combination of REITs would be $37.5. Of course, some REITs do have the higher standards, but most may not, is my point. So REITs are actually easier to get into as well compared to most other alternative investments. They're typically those are organized as partnerships. Now, in addition to the lack of liquidity, another thing that amplifies the complexity and the risk of these different types of private placements is the use of leverage. What's leverage? Well, leverage, just like in physics, is something that you use to amplify the amount of output that you get from the amount of work that you're putting in. So how is that done with investments? Well, investments in many senses are a lot like science, where as opposed to purchasing investments outright with cash, your rate of return on a cash purchase is dollar for dollar, percentage-wise, simply the amount that you earn versus the amount that you invest. However, if you borrow any percentage of money for the purchase of any investment, your return on equity is amplified. It's amplified if, for instance, let's say you buy an investment for, just to keep it simple, $150, and you borrow $50,000, let's say on margin, or either that or the REIT or the partnership borrows 50% in addition to your investment contributions, but you only invested $100 of your own money. Well, your total capital that goes to work for you is now $150 instead of $100. So you're working with a larger base against which a return can either be earned or lost. So a 10% return on $150,000, including $50,000 that was borrowed, is 15%. It's 15% against the amount that you paid cash for, even though it's 10% against the entire portfolio. So the amount that you borrowed, because it's not ownership, your net asset value is only based upon the net equity of $100, but you earn more money on the broader value of the assets within the fund. Well, your return commensurately is going to be either larger if the money grows, or correspondingly, and unfortunately as well, borrowing on margin, or the use of borrowing at all with leverage, likewise reduce your return on a loss. So for instance, if you lose $10,000 as opposed to earning $10,000, that part of your portfolio, and that's against $150,000, then your losses are going to be $15 per share against $100,000. So your loss is 15% instead of a loss of only 10%. See, there's no difference. It's just going in the opposite direction. So my point is that leverage can either amplify your returns or it can amplify your losses, because it has the same amplification in both directions. That amplification incurs greater risk. It includes a greater range of possible returns and losses that are unknown. And so because we can earn more, but we can also lose more, you have a higher risk profile. Higher risk can mean higher return on the plus side, but it might mean less return on the downside. So borrowing on margin amplifies that volatility. Another way to use leverage is by using derivative contracts, which are simply futures and options. If you remember those, as I discussed with my investment podcast a few weeks ago, futures and options are simply contracts to buy or sell a certain underlying investment at a certain price before or at expiration. So if you look at the underlying investment, if it's worth $100 a share, and you buy an option to purchase it at $90 per share, the intrinsic value of that option is $10 a share. Now, meanwhile, if the price of the underlying investment increases or decreases one way or the other by $5 per share, well, $5 per share on the underlying security is only 5%. But $5 per share on an option with an intrinsic value of $10 per share is 50%. So you're magnifying your leverage by 10x with that specific options contract. So like I said, it comes with a much higher degree of risk when you borrow money to manage investments, one way or the other. So it's something that, here again, how far are you willing to push the possibility of improved returns on what part of your portfolio, or on how much of your portfolio percentage-wise are you willing to do it? These things, these different programs are inherently much riskier in most cases than a traditional stock portfolio. There's no question about it. So even though, likewise, remember I mentioned that the major purpose why people use alternatives at all is to have a different correlation of performance with the stock market in bonds and traditional investments. You have the negative correlation, which allegedly helps to reduce risk. That's not always true when you use high-risk strategies, which include leverage, whether it be borrowing on margin or using futures and options as derivative contract. The risk of whatever you invest in, whether it's an alternative or a private placement, also will depend upon the volatility of the underlying asset class or the asset class is used. So if you look at the difference between investing in private equity versus public equities, guess which category is much riskier? It's the private equity. It's because there's no market for the underlying companies. Their valuations are based upon independent appraisals, but you have no idea how well these companies are doing at all, unless you get a copy of the different companies that the private equity manager is actually using. Even if you get a list of these companies, you can't do any research on them to find out what their operating performance is. So you have to rely entirely on the manager for hopefully doing a very good job of the portfolio over a range of investments that you can't even follow, like you could as if it were with the stock market. Also, many hedge funds that invest in esoteric categories, such as commodities, which might include not only oil and gas, but agriculture, metals, etc. Those asset categories are inherently more volatile than any of the traditional investments you may be more familiar with. Their ups and downs are more frequent, they're less consistent, and their performances, even over long periods of time, may be much less predictable. So even though your alternative investment was originally bought with the idea of reducing risk, there are so many factors within that portfolio that can amplify risk, is that you may not be getting a lot of diversification benefits with something that risky. Also, with a private placement, if you thought investing with an advisor might be expensive, even the base management fees on most of these private placements, whether they're real estate, hedge funds, or what have you, are at least twice that of someone like myself would charge. So typically, the base management fee is not 1%, but 2%. In addition to that, the fund managers or the partners might actually earn 20% in excess of any performance minimum. So despite the 2% fee, if the fund net asset value increases by a certain threshold, such as 10, 15, or 20%, any excess performance might be subject to a 20% surcharge in the fee that you're paying. And then to add insult to injury is that not only are there management fees assessed by the partners, the fund managers, what have you, the advisor will still charge his or her fee on top of that, okay? Also, in terms of cost, remember we were talking about leverage and using borrowing on margin or borrowing in general for any of these investment strategies? Well, that borrowing incurs interest expense on the fund or the partnership. That interest expense will also reduce your returns. So it's kind of ironic that on the surface that in many cases, these investments are pitched as a diversification tool, which might reduce your risk. But the fees involved, whether it be the management fees and or the margin borrowing, might easily work against you for that particular purpose. And, my own personal experience, both as an advisor and as an investor, with considering any of these different types of strategies, is that the vast majority, and I would guess at least 90% of any alternative investment or private placement that you encounter, whatever it is, private equity, private credit, real estate, any type of hedge fund, oil and gas, if you look at the net performance after fees and interest, the vast majority of these alternatives do not add any positive gains relative to the S&P 500. In fact, it's often much less. So we're trying to produce a better alpha, which is a better risk-adjusted return, by going in a direction opposite of the stock and bond market. But if the investments are using are so risky and so expensive that they don't generate, hardly any of a return, or not much better returns at best than the S&P 500, why would anyone in their right mind use them? I'm not saying that all alternatives are bad. I'm saying that many of them I would consider substandard, and you have to do your own due diligence because there's a complete lack of transparency with most of these. Hedge funds have frequent turnover, so you never know what they actually own, even if they give you a list of the different investments in a portfolio. Next week, it could be entirely different. And especially with private equity, private credit, as I mentioned, the companies that they list for you, you're not going to be able to research yourself anyway. So, in my opinion, I'm not saying that good private placement investments are alternatives. I'm not saying that good examples of these don't exist somewhere. But based on my own due diligence, finding a good private placement, it's almost like digging for a needle in a haystack. And if you find one, good luck. But in most cases, if you find one that doesn't turn out well for you, you're stuck with it for the expected holding period. Whatever that is, 5, 10, 15 years. And you can't meaningfully diversify out of it or liquidate it because you're stuck with the limited liquidity of what they allow you to withdraw, which is a very small percentage. Whether it be the annual monthly amount or the dividends are paid, it's a very small percentage of the portfolio. So you're stuck with an investment that may not perform well for you at all. In fact, there's a much greater probability that it won't. I guess what I hate to say it, because I'm trying not to sound biased, but I can't help myself, is that the way many of these investments are pitched, and pitched by other advisors even, is they try to make you feel special and that you have special needs because it's either an accredited investor or a qualified purchaser. You're Mr. Moneybags, so you must be privileged. There's not everybody who can use these, so you're the sophisticated investor. You should be introduced to ideas that you're not familiar with that are complex, restrictive, expensive, and risky because that's the only way to do better. Huh? Maybe not. So they're kind of pushed as a way to, quote-unquote, address the special concerns of high net worth individuals and families because of either due to a negative correlation with the stock market or tax loss pass-throughs. But especially with tax losses, man. You got to keep in mind, for every tax loss, you're only getting a percentage of that loss back with tax savings. So if you have a loss of, let's say, $10,000 and it passes through some way, you're only going to get a fraction of that loss back in tax savings. So why are you trying to incur losses? Who would anyone in the right mind? I want more losses. I want to lose money so I can take the tax deduction. How crazy is that? Think about it. A tax loss is a good, I don't want to say excuse. It's a good consolation. If you bought something in good faith and you thought it was going to make money, but it didn't because you were simply wrong, or the laws of probability didn't work in your favor, or maybe there's a casualty loss, then fine. If the IRS is willing to give you a break because of those circumstances, yeah, maybe you deserve it. But if you go in purposely in mind saying, I want to lose money in my portfolio to take the tax loss, I'm sorry, but you should be sent to the second Tuesday of never. Okay? So think about this before you make an investment. If something is pitched to you that sounds better than what it is, or sounds too good to be true, probably bad. You need to be knowledgeable. You need to do your own homework. And you need to make wise decisions. So that's where the due diligence comes in. And, for the most part, as I've considered these investments, for any of my clients, here's where I go through 250-page offering memorandum, which will discuss the different objectives that might be used, the fees, the maximum leverage or borrowing that might be incurred, the expected holding period, the liquidity limits, how the entity is formed, and how it reports distributions and what the tax implications might be. I'll understand all this in advance for you. If you want to do this yourself, good luck to you. I don't know many people who would voluntarily spend at least half a day, if not longer, looking through a 250-page memorandum in order to better understand what they're investing in. Many of these times, like the offering entity might provide fact sheets and summaries, which sometimes are helpful, but here again, it's still not full disclosure. You need to have some sort of full disclosure as to the risk, the cost, and liquidity constraints before you're in a position to understand whether or not it might be a good investment for you. But what I found generally is most of these different hedge funds and private investments, alternatives, whatever the case might be, it's like opening a Pandora's box. It's like going down a rabbit hole of complexity where none of that work or effort or research or due diligence may even pay off for you. It's like a box of chocolates. You'll never know what you get. So generally speaking, first, you need to have the money in the first place. But even if you do, just be very grounded in how you consider these different instruments for your portfolio. But most importantly, for the vast majority of you, even if you like investing, even if you like making your own decisions, you might want some professional help and guidance in deciding whether or not this type of strategy could be right for you, how it fits into your portfolio, or how it could be used more strategically to accomplish your overall objectives. God, what does that sound like? It sounds like that as part of developing your investment strategy, you might want to consider some more in-depth planning that encompasses this and many other things. Which reminds me, one of the best things that you can do to better educate yourself, if you haven't already, consider downloading my pamphlet here. What is financial planning and how does it help? This is your financial planning bubble. So not only will it discuss investments with you, but equally important, it will discuss my overall methodologies, how I work with clients, the sensitivity and care that I put into working with you and understanding your needs, and designing an effective plan that has purpose to it and makes sense on a holistic and comprehensive basis. I can't say any more than that, because that is the critical distinction between many individuals who are just selling a product versus giving advice. And even those who are accredited and are giving you good advice, their advice is only as good as their intentions might be, or their knowledge itself might be. And that's why you need to be able to work with someone who has a vast level of experience, more than 30 years of working with the public, and those like you who are striving for financial independence, financial security, and financial success. You fit these categories, there's no reason why you shouldn't consider working with someone like me. And this is just one small example. It's a small example, but we just went through this rabbit hole. And think of how deep we went as to the ins and outs and complications, pros and cons, good things, bad things. It's something that you need to fully consider to make a well-informed choice. So hopefully you found this podcast helpful for you. What I'd like to ask you to do, in return, if you could, to show your interest and be able to have this channel have greater exposure, subscribe to this channel, like the podcast. And with that in mind, take care. Neil Gendreau and these videos are not intended to provide specific investment or financial advice. Please contact your own financial advisor if you have one, or if you don't, why not contact Neil?